Hey, happy Friday, everybody. Welcome back to all of our options traders. And last week we got an interesting post from one of the traders in our forum asking about an option where he used a 60 strike and he said that the option had gone in the money and then subsequently fell out of the money. And his question was, does this render the contract null and void, or would somebody still be able to exercise it? It's a good question. You get that a lot. And part of my answer was, even if it does fall out of the money, doesn't mean that it can't be exercised. And when you bring up that point, the next obvious question that traders have is, well, why would someone exercise an out of the money option? Another really good question. So let's kind of combine these things. Let's take a look at his question about an option moving in the money and then out of the money, and then also why it's possible to find out that you might be assigned on a short option that expires out of the money. So before we get started, please be sure to click like and subscribe. It's greatly appreciated and helps to promote the channel. So for questions like this, it's always super important to go back to the basics. Remember that at their very core, options are a market for rights versus obligations. Long options have rights. Long just means that you bought it, so you pay money for those rights. Short options have obligations, and you will receive money for accepting obligations. And so right off the bat, once you understand this idea of rights versus obligations, you'll see why it's wrong when traders say, oh, you should never buy an option because they decay. You should only sell options. Well, that's completely missing the point, because that's saying you should only accept obligations. There are a lot of reasons why you might want to have rights. And to make the best use of options, you will probably need to use both. So just remember that when we're looking at options, it's always about rights versus obligations. Now, when you buy an option, whether a call or put, remember that long options have the right to exercise. That's part of what you're paying for. But you also have the right to walk away. You're not required to exercise ever. And the right is in force if the option hasn't expired. That's really the dividing line. If the option is in force, in other words, it hasn't expired, it can be exercised. As I've mentioned in other videos, options are time dependent, they are not path dependent. And that just simply means their ability to work or to hedge or to be exercised simply depends on time. It depends on whether they're still alive or not. They are not path dependent. So in this person's question about the option moving in the money and then out of the money is not going to have any bearing on your right to exercise. Now, for a little side note here, there are a class of options that are called exotic options. These are not listed on a standardized exchange like the SIBO, the ones that we're used to trading. But exotic options are really OTC, they're over the counter. They have to be independently drawn up. But there's a category called barrier options. And within this, you'll hear knock-in options and knock-out options. And those will trigger if that strike is breached. So it's possible that this trader might have read about barrier options and just confused it with equity options that we typically see in the stock market. But the thing to understand is that for the stock market, this right to exercise or the right to walk away does not expire at 4 p.m. Eastern Time on the closing bell, on Expiration Friday or whatever the expiration day might be. It does not depend on that. And the reason is that traders may exercise until 5:30 p.m. Eastern Time. And I talked about that recently in a video under the title, When Does an Option Expire? So it's kind of the same topic here, but I wanted to address this trader's question. So the thing to remember is that if you buy an option, you have the right to exercise, or you also have the right to walk away and say, I don't want to exercise. That simply depends on whether the option is alive or not on the path that the stock takes. So for example, let's say, using his example, the 60 strike, and here's our hypothetical stock moving along, and it starts out below 60, and then all of a sudden goes above 60. It's in the money. This was his question. And then it subsequently came back down below 60. and I think he said to 55. So it sounds like it was a real example, maybe something that happened to him. But regardless, the point is that it was out of the money, moves in the money, and ends up out of the money. Again, the path has no bearing. What matters is this dotted line over here. That's our expiration date. As long as the contract is alive, the path that it takes has no bearing on whether the long position can exercise or say, I don't want to exercise. So even if it expires in the money, the long trader, the person that buys the option, can call the broker and say, I don't want to exercise. You're never required to exercise it. Now, this was the example that he used where it closed, let's say, 5 points out of the money. And I did mention that just because it's out of the money, it still could be exercised. And that's really what we're trying to explore here in this video. And so this would be highly unlikely that somebody would exercise at 5 points out of the money unless news broke. Maybe there's an earnings announcement at the 4 p.m. bell and the stock is now trading above 60. Sure, you can expect to get assigned on Monday morning if you're short that option. But here's where it gets even more interesting, and a lot of people make this mistake. Let's say that it closes just barely out of the money, maybe at 59.95, maybe even 59.90. And some traders will say, well, on Monday morning, I'll still have my shares. I'm not going to get assigned because it expired out of the money. And the call buyer can't exercise an out-of-the-money option. Yes, they can. Remember, it's a right for any reason. But the question again is, why would somebody do this, even if there's no news? Well, here's a very common reason. Let's say that you have a hedge fund that maybe holds 10,000 contracts. They bought 10,000 calls. And the reason they did this is that their goal was to actually buy 1 million shares of stock. Remember, each contract controls 100 shares. So if you own 10,000 call options, you could exercise for up to 1 million shares of stock. That's a big purchase. And so maybe the hedge fund bought these 10,000 calls maybe to get through an earnings report or several of them. They wanted to see how the future unfolded. They wanted the right to walk away, but now that they see that they're at expiration, they've gotten through these critical earnings reports, they want to buy the shares. The problem is that if that option is just out of the money, so in this example at 59.95, buying this many shares at the close would drive that share price up. Could you imagine waiting until 3:45 p.m. and putting in an order for 1 million shares at market and the stock's at 59.95? Be highly unlikely that it wouldn't jump past 60. So this is where the hedge fund might say, you know what? Yeah, it's technically out of the money, but we're better off exercising. So this is where you can see an out of the money option getting exercised. And this was an extreme example, but it could just be an individual trader, somebody who says, I just don't want to even deal with putting in a limit order and maybe not getting filled, or a market order and getting something above 60. Let me just exercise it because it's so close to the closing bell. Or maybe the trader missed the close, comes back and says, the stock closed at 59.95. Who knows what it's going to be on Monday? Let me submit exercise instructions. So the main thing to remember is that long options may exercise at any time for any reason. Now, another little side note, this is assuming that we're talking about what are called American-style options. Remember, American-style options can be exercised at any time. There's another style that's called European-style. Those are typically more for indexes, not the equities, but that is also a little caveat. If you're dealing with an index option that's a European style, you would not be able to exercise that early. Or if you were short that option, you wouldn't expect to be assigned early. That could not happen. But if you are trading options on stocks, so Microsoft, Nvidia, AMD, name your stock, it's an American style option, and that can be exercised at any time for any reason. So if you are coming into, let's say, expiration Friday, and you're short the option, and it's slightly out of the money, possibly even quite a bit out of the money, But there's potential news, there's an earnings report. Anything could drive this in the money. And if you don't want to be assigned on Monday morning, what do? Close the option prior to expiration. There's nothing worse than seeing a perfectly executed plan come completely unraveled on Monday morning because you didn't understand the mechanics of option exercise. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a Candlesticks and Technical Analysis course. It's all at optionsA2Z.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.